You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, my co-host John McEwen. In this week's episode, we're going to be discussing Pennon, Johnson Matthey, B&M, Intertek, Bloomsbury Publishing and Fiverr. John, shall we kick off with Pennon?
Yeah, we'll kick off with Pennon. So for anybody who doesn't know, Pennon's a water company, so essentially a utility company that supplies water to most or a lot of the southwest of England. And they had their full year results out, and here are some of the highlights. So their underlying revenue rose 1.2% to 644.6 million. However, the full year underlying operating profit fell 12.3% to 215.3 million. That was reflecting the impact of the new K7 regulatory period and costs associated with the pandemic. The sale of fvrr, which was a waste management business, contributed a £1.7 billion increase to profits, and £24.8 million worth of new contracts in Pennon Water resulted in bringing a full year profit after tax of £1.8 billion. Breaking those results down further, South West Water revenue fell 1.3% to 563 million. That was mostly down to the regulatory changes. COVID had limited impact on revenue due to the higher household demand, which was more than offset by the lower business demand, which is interesting because that certainly wasn't the case for some other utility companies, particularly energy suppliers, where they suffered more of a loss from the business customers than they did from the gain in the home consumption. But that aside, underlying profit for the division fell 9.4% to 222.3 million, with high costs associated with the pandemic and inflationary pressures. External revenue for Pennon Water Services was up 21% to £81.2 million, with operating profit down £0.7 million or £700,000 from £1.2 million in the previous year. After the varietal sale, the group now has 64.3 million in net cash, compared with 3.3 billion in net debt at the same point last year. Operating cash flow was down to 396.8 million from 449.4 million in the last year. And after the sale of Veridal, the group is putting 1.1 billion towards debt reduction and in the process of spending 425 million pounds to acquire Bristol Water, which has 1.2 million customers and 389 million pounds of debt. And 1.9 billion pounds is being returned to shareholders through a special dividend, and that accounts for 1.5 billion of that figure, and share buybacks, which is a further 400 million. So Pennon has a market cap of 4.5 billion. It's listed on the FTSE 100. In terms of its price to book, it's currently stands at 3.18, and that compares with a 10-year average of 2.83, and it's currently yielding 2.3%. Sam, what do you make of Pennon and how it's doing?
I thought it was fine. I guess I can see the appeal of it as an investment, and it's probably quite an easy business to run. No disrespect to the management, but you've basically got a monopoly, and as long as you don't take the mick, you're just fine. You don't really need to do anything else. I think the Bristol Water acquisition makes sense. My main concern with it is I think most people buying it are probably buying it for the income, and I think a prospective yield of 2.3% is actually probably fairly low. And additionally, I wouldn't like to have an investment that was so much at the mercy of regulators. And as we've seen that with the new regulations that's come in, where they're not allowed to make as much profit now.
Yeah, I think that definitely is a problem for me. And there are probably better bond proxies out there that you could buy than Pennon, and ones that aren't sort of subject to so much regulation. I think, particularly since 2017 with Theresa May, with the energy price cap, it has been harder for utility companies to make profit and return it to the shareholders without governmental interference. So for those reasons, I don't think it would be one that I'd go for. But yeah, I think the traditional reasons for buying a utility company in the UK, at least, is not as benign as I think it probably once was.
I don't really see why you'd buy it other than for the income, and a 2.3% dividend is not that high.
Yeah, I mean, I can think, and you can think of some, well, we talk about it quite a lot on the show, but of a really high quality business like, say, Diageo, and that's probably got a similar yield on it.
It's about 2.5, isn't it?
It's about 2.5, and it's got much more scope to grow as well.
And it's just a better business.
Yeah. So, yeah.
I'd probably just rather buy the index, because even like the FTSE 100, that's going to be over 4%. All shares going to be over 3%. I'd rather hold either of those indexes to Pennon, probably. Yeah,
there are a lot of companies I could list, especially for income, that I'd rather own over Pennon. That's for sure.
All right, well, moving swiftly on then.
Okay, what do we have next on the list?
We've got Johnson Matthey. Johnson Matthey is a provider of catalysts and catalyst systems to reduce emissions from vehicles and industry.
So sort of the catalytic converter in your car.
Yes, it makes it less harmful to the environment, the emissions.
Yeah.
So the company has 4 sectors, which is clean air, efficient natural resources, health, and new markets. The clean air segment is the catalysts and the technologies that abate emissions. The efficient natural resources segment offers products and processes that convert and recycle scarce resources using less energy and fewer raw materials to chemicals, energy, transport, and healthcare sectors. Health segment provides capabilities in complex chemistry, manufacturing, and scale-up to create active pharmaceutical ingredients and other solutions for niche areas. And the new market segment is engaged in applying science into emerging opportunities such as battery materials and fuel cells in the healthcare, transport, energy, and chemical segment. So a lot of what they do is tied to internal combustion engines, and they're trying to pivot to doing the battery technology as well, so that as one declines, the other will hopefully replace it. They have come out with their full year results, and they reported a 5% fall in underlying revenues to 3.9 billion, which was in line with expectations as lockdowns hit the clean air sales, particularly in the automotive sector, as you'd expect with less people driving. In addition to that, they had higher administrative expenses, which brought the underlying operating profits down 5% to £504 million. The board proposed a final dividend of 50p, bringing the total to 70p, which was up 26% from last year, but still below the pre-pandemic levels. So by segment, revenue for clean air was down 7% to 2.4 billion, with underlying operating profits of 269 million, which was an 8% decline. And that reflected a weak first half, whereas sales rose in the second half and margins approached pre-COVID levels by the end of the second half. The efficient natural resources segment saw sales decline 1% to 1.1 billion. Profits rose 6% to 268 million. Health was up 8% to 237 million, and profits rose 15% to 31 million. However, this division remains under strategic review. COVID-induced weakness in battery systems and medical device components meant new market sales declined 6% to 356 million, and underlying operating profits were 9 million. However, the group's first eLNO plant is on track to start commissioning in 2022 and targeting commercial eLNO production. I don't know if I've pronounced that right.
And what is that?
So it's a battery component for the electric batteries. Yes, so they're targeting commercial production in 2024, and 2 customers are currently in advanced testing stages for cathode battery materials. And hydrogen technologies brought in roughly 100 million in sales, split between fuel cells and production technologies. Strong growth in this market meant the group has increased its manufacturing capacity in the UK and China for an overall capacity of 2 gigawatts. The division is expected to yield sales of roughly 200 million by 2025. Free cash flow is 305 million, up from 266 million, as the group reduced inventory levels. The group's cost-saving program, which is targeting 110 million in annual savings by 23-24, accounted for 171 million in spending this year, which resulted in a 37 million pound saving. And including pension obligations, net debt rose by £40 million to £815 million, or 1.2 times cash profits, which is below the target range of 1.5 to 2 times. In terms of the valuation, it's trading at a forward PE ratio of 14.1, and that's in line with the 10-year average. It's got a prospective dividend yield for the next 12 months of 2.4%. John, thoughts on Johnson Matthey and these results?
What are the materials that they actually put in the catalytic converters? Platinum and...
You've gone beyond the scope of my knowledge.
Yeah, I think they do have some, they do have kind of precious metals. Because the thing I was going to ask was, in that sort of main part of the business, had the commodity prices impacted the performance?
It's not mentioned it, or they haven't mentioned it. And I think if it had, they probably would have done. With the results being down, I think they would have been quite happy to blame it on that.
That was just one thought with all of the talk about commodities. And what's their R&D spend? Because it sounds like it's very knowledge intensive and capital intensive as well. And you would assume that they're going to have to increase that a lot if they're to make this sort of successful transition from, I suppose that almost the old world industry that they're in at the moment.
Just have a look at the income statement; it'll be on there. Yeah. So total research and development expenditure was £194 million, and that's on revenue of 3.9 billion and profit of 504 million. So it's not that huge.
Is it something that you think they will have to increase though, if they're to have this sort of successful transition?
I guess if they're already in the advanced testing stages for the materials, that suggests maybe not. It's not like they're just doing it with a hope and a prayer. I mean, if they're going to start commissioning them, taking commissions in 2022, that suggests they are well on the way.
Yeah.
So I think not. I guess although it is different, it's sort of in line with what they've been doing anyway. It's not that much of a jump. I think it is quite a logical.
And what percentage of the revenue did you say came from the sort of traditional side of the business still?
So it's 2.4 billion comes from clean air, and that's out of 3.9 billion total.
Two-thirds. So it's 2/3. But you see, I mean, I wouldn't necessarily be all that pessimistic going forward, because once the sort of recovery from COVID has begun, I still think probably the traditional oil and gas, which I guess that's where your catalytic converters come into, probably still has a long way to run. And even with targets across the world for the ending of fully combustion engine cars, there's still commercial vehicles and industry that's going to be reliant on fossil fuels. So I think even if they didn't make the switch completely, that area of the business is still very profitable, and it's something that may even grow. It's who's to say whether we're at the peak of that yet for them.
Yeah, I think a PE of 14.
Yeah,
I'd say the internal combustion engine. I mean, even like the most pessimistic person, I think it's fair to assume it's still going to be around in 10 or 15 years.
Yeah.
So absolutely. I think at that PE, it's fine. I sort of think if they can make the transition to electric and to batteries, that's probably not really priced in, I don't think, at the current levels.
No. And they're still producing cleaner air at the end of it, regardless of what the sort of the fuel being used is. Yeah.
So they're not, I don't think it's the same as...
They are on trend.
Yeah.
So no, and I suppose, the figures obviously impacted by COVID, but you'd hope that they'd recover more, and it's not an outrageous valuation for those figures, I don't think, or for those results, I don't think. I don't pretend to know about the industry, so it probably would be one that would go in the sort of the too hard pile, but one that I'd be interested in probably looking at further. But I don't know enough about the industry to really be able to comment.
No, I mean, it seems reasonable. Less people have been driving in the past year, so you would expect a decline.
And I do wonder whether the commodity price, whether that's going to have any impact on them. But
if those are the full year results, maybe it's going to come in the next year.
Yeah, probably. Or if it is going to come, it'll come in the next year.
Yeah. All right, should we move on to B&M?
Yeah, so
B&M. A simpler business to understand.
It's a simpler business to understand, and the results are some of the best that I think we've seen in the last few weeks. Full title is B&M European value retail. It's a discount retailer, and it was recently promoted to the FTSE 100 last year. They've had their full year results out, with some of the highlights being that the group revenues were up 25.9% to £4.8 billion. Pre-tax profits rose by 108.5% to £525.4 million, compared with the £252 million of the previous year. With the chief executive, Mr. Aurora, said that this was proof that you can still make money out of physical retail. Underlying earnings also increased 83% to £626.4 million. And that was also helped by running fewer end of season sales. There was a net increase of 25 new stores, with 3 new stores in France. Cash generated from operations was up 75% to £944 million. Operating costs within the main B&M UK division were up 24.4% to £913.8 million. And if we break the revenue streams down further from that £4.8 billion figure, £4.07 billion came from B&M UK, which was its revenue growth of that division of 29.9%. And in terms of adjusted EBITDA, was an 84.7% increase to £590.7 million. Going back to that overall revenue figure, £414.8 million came from Heron Foods. That's a 6.4% increase. In terms of adjusted EBITDA, it's actually down 3.5% to £24.6 million. And the company has attributed that because the Heron Food stores tend to be in town centre locations, unlike the B&M stores, which are often at retail parks. So they think that was why Heron Food sort of suffered disproportionately. And then there's also the French division, under the French discounter Babu, which had revenues of 309.1 million, and that was up 9.1%. And adjusted EBITDA was £111 million, and that was up from a £3 million loss the previous year. So that was a real improvement there. And the group completed a refinancing package in July 2020, maturity on both £300 million loan facility and £155 million revolving credit facility, which has been extended to April 2025. And they issued a £400 million high yield bond maturing in July 2025, used to pay the existing £250 million bond. Ongoing adjusted net interest expense of £24 million a year. Operating cash flow stood at £668.2 million compared with £319 million previous year. And it very much helped B&M that they were considered an essential retailer during COVID, and they were allowed to stay open through all of the lockdowns. And they note that they particularly benefited from the popularity of homewares, DIY, and gardening, which you would question whether they were essential, but they did benefit from those. And they were able to waive the business rates relief, which were around £80 million. They've said that they'll be paying dividends totaling £697 million in 2021, including £450 million of special dividends, which represents an increase of 113%. So they've got a market cap of £5.39 billion and a price to earnings of 13, prospective yield of 3.2%.
Yeah, I don't understand why it's so cheap.
But you don't understand why it's so cheap? To be honest, I don't either.
I mean, it
sounds like they've issued the £400 million high yield bond, but no, it's strange given those figures. And actually, if you look at the revenue growth and the earnings growth, if I just get that up.
So in the past 5 years, revenue's doubled and operating profits tripled.
Yeah, so going back to when it went public in 2016, revenue was 1.9 billion. And then obviously for this year, it's 4.8 billion. Adjusted EBITDA back in 2016 was 181 million, is now 626 million. I don't understand. And with that growth, why it's quite as cheap as it is. I don't know whether they're going to, if inflation increases, whether they'll have particular pressures from that, whether it's worry about, staff wages. They did say that they'd increase staff wages, but they are sort of around the minimum wage. Whether it's a longer term worry around physical retail. But I mean, I think it is, like the chief executive says, a good example that physical retail can still succeed.
This isn't a company that's just holding its own, is it? I mean, since it's come public, it's delivered.
Absolutely.
So I don't know why it's so cheap.
No. And I suppose you do think of other discount retailers have really struggled, like Poundland, but B&M, I think, is quite a different beast, really.
It's barely even a double since it went public.
Yeah.
It's been public for years. And given that, in the last 5 years, revenue's doubled, operating profits have tripled.
And I suppose one thing you might say about it, would it just be, well, I don't think this is true, but would it just be sort of more cyclical, a business that does better almost in the downturns when family budgets are struggling? But actually, I mean, we haven't had a recession. I mean, COVID aside, in that period prior, and it has still had impressive growth.
Yeah, I would expect it to do better in a recession.
So actually, those numbers where we haven't been in a recession, it's done very well. And so it's proved that it can grow in either environment, really.
Do you think maybe just people don't want to own B&M? It's just perceived as being like a bit
snobbery.
Dirty. Yeah.
Well, some people say that it's, lots of middle class shoppers who like bargains that go to B&M. But in fact, they did have a slide in their results. I think it was from Barclaycard, the UK shopper population types. And I think their primary shopper is what they call the family backbone. Families on tight budgets, ages between 25 and 49, wealth low to middle, and they have children. But I mean, I would have thought it really does. It does appeal to everybody, B&M. I don't think it is actually. I think it's got a wide spectrum of people who go there, which is probably why it does so well.
Yeah, I mean, I guess you'd say, well, those results, they're not going to be able to do that every year. It probably has benefited from a lot of its competitors being closed, especially given its maybe dubious status as an essential retailer. But I'd say at a PE of 13, it doesn't need to repeat those results every year.
No, that's right. I mean, if we were talking about a PE of 40, it would be a different story.
But even then, even if it doesn't repeat the results, I mean, based on the prior years where it was called them normal years, it was still impressive growth.
Yeah, that absolutely. And the French operation, that I'd have to dig down more into that, but that's been very profitable as well, which is an improvement from the loss that they made last year. So I think that the future for it does actually look bright.
One for the watch list?
Yeah, definitely. One for the watch list.
Should we move on to Intertek now?
Yeah, go ahead.
So Intertek, for anyone who doesn't know, they are a quality assurance company. So they basically do anything to do with ensuring the quality and safety of physical components and anything you can think of, really. They'll do cargo inspections, analytical assessment. They'll literally they'll test toys and stuff like that. So any kind of product or service, they'll basically do the testing for it and make sure it's safe. So they have come out with a trading statement, and they've said that in the first 4 months of the year, their like-for-like revenue was up 2.7% to 855.4 million, as 9.3% growth between March and April offset a 4.1% decline in January and February. They said products was the only division to report overall revenue growth in the quarter, and the group is on track to deliver full-year revenue, margin, and free cash flow targets. The products division, which makes up 82% of profits, saw a 7.4% increase in revenue to 526.8 million, the result of double-digit revenue growth across most product lines. And they said that was helped in some areas by North American trading and increased in e-commerce. Revenue in the trade division, which makes up 11% of profits, declined 2.2% to 184.8 million, as declines between January and February offset growth of 5.3% in March and April. This was largely attributable to the decline in bulk commodity inspection services as global mobility remained below pre-COVID levels. However, the division is expected to deliver full-year revenue growth. The resources division, which makes up 7% of profits, declined 6.6% to 143.8 million, and full-year revenue for that segment is expected to be flat. For the full year, they expect capital expenditure of 110 to 120 million. Net debt is expected to come in between 350 and 450 million, which excludes the group's SAI acquisition. If all goes to plan, net debt, including the cost of the merger, is forecast to be between 883 and 885 million. The SAI merger it was announced in May, and it's Intertek expanding its global assurance offering with the acquisition of SAI Global Assurance, which is another leading provider of assurance services. It was noted in the article I'm looking at that they're paying 15.5 times forecast cash profits. However, that's pretty close to where Intertek shares trade right now. However, $855 million of new debt will be going on the balance sheet, which will almost double it. In terms of the valuation, business trades at a PE ratio of 29.7. That compares to a 10-year average of 21.9. And a prospective dividend yield for the next 12 months is 1.9%. Last 5 years of financials, revenue has increased from 2.56 billion to 2.74 billion, so not a huge jump, and earnings per share are basically flat as well. So my view is a PE of 29.7 seems very expensive. What are your thoughts, John?
Yeah. I mean, it did have sort of aspects of it that looked like a quality business, but it's very expensive for. Well, to me, it seems very expensive for what it's been delivering.
Yeah, I think if you're paying that kind of ratio, you're paying for growth, and it's not delivered growth. The only growth you're going to get is through the merger, and that's you've acquired the growth. You've not actually.
Yeah, and what's debt at the moment? What's the debt doing?
Well, the debt's about to double. Well, let's have a look at what it was for the December 20 year end. It's probably about 800 million.
Okay, and it's got a market cap of about 8.5 billion. So.
Let's see how much profit it makes a year. It's making 260 million a year after tax. I think the debt's probably it's probably in a manageable range. I don't think it's a huge issue. If it's going to double, I don't think there's much of a problem, providing the revenue and earnings are going to double as well.
Yeah, and I suppose that as well, just with the global economy getting moving again, Intertek's a company that's going to benefit from that massively.
Yeah, I think it is.
So, the price to earnings perhaps isn't as outrageous given what's factored into it.
Yeah, although it's... I'll just have a look at what it was in the... Yeah, so there was a small drop from the 2019 year to 2020. So full year 2019 revenue was 2.987 billion. Then it drops in 2020 to 2.741 billion. Mm-hmm. So I guess it is a slightly depressed earnings figure, but it's not that depressed. So maybe it's like a normal PE of say 25. Yeah. But to me, that still seems quite expensive.
No. So is it one that you'll be looking at or putting on the watch list?
Probably not, no.
Probably not.
How about you?
Yeah, probably not either. I think there are other ones. I mean, B&M certainly. That was the big surprise of the week for me, but I suppose we're still not finished, so you shouldn't put out any more spoilers. Okay, so we've got a smaller company, which you've certainly probably come across some of the books that they've published, which is Bloomsbury. So they're a publisher which has Harry Potter, and they had some very positive results coming in for the year, with revenue up from 185.1 million from 162.8 million pounds. And that was particularly driven by their consumer unit, with revenue in this division up to 118.4 million pounds from 96.8 million the previous year. And in particular, Harry Potter sales were up 7% last year. Not sure whether that's down to COVID, more people at home. Children at home need to be entertained. And their non-consumer division, which includes the academic and professional divisions, that saw revenue more stable, but it was up from 66 million to 66.8 million. The consensus for the city forecast for Bloomsbury's 21-22 profit before tax was 177.5 million. So it was ahead of city expectations. And the pre-tax profit for the year to February the 28th, 2021 was 17.3 million, up by 31.1% from the 13.2 million reported for the comparable period last year. Revenues climbed to 185.1 million from 162.8 million if we compare the same periods. And the company said, whilst the board remains mindful of the external environment, the outstanding performance in 2020 to 2021 increases our confidence in the strength of the business and long-term strategy. Nigel Newton, the chief executive, said the popularity of reading has shone a ray of sunshine in an otherwise very dark year. And it's the blacklist titles really struck a chord with readers throughout the pandemic on themes such as humanity, social inclusion, escapism, fantasy, cookery, and baking. Some of their bestsellers were Why Am I No Longer Talking to White People About Race? Such a Fun Age by Kylie Reid, Humankind by Bregman, and Crescent City, House of Earth, and Blood by Sarah J. Maas. The company also announced that with these good results, they'd be having a special dividend of 9.78p per share, which is worth a total of £8 million. And they've said that they greatly appreciate the support of their shareholders during such unprecedented circumstances last year. And they've recommended the final dividend of 7.58p per share, which is worth another £6.2 million, bringing the total dividend to 8.86p per share, which is up 8% compared with the previous year. And on the results, the shares rose 12.3% or 38p to just under £3.50. And the market cap is currently £282.4 million, price to earnings of 18, and a prospective dividend yield of 2.5%. Sam, thoughts on these results?
It's probably a year. I mean, it was good results, but it's probably a year that's not going to be repeated. I thought that I had looked in at the past 5 years of results. Revenue increased slightly. If you exclude the bumper 2021 year, revenue increased for the previous 4 years from 142 million to 162 million. Earnings per share, however, increased from 9.83p to 13.58p. It looks like a quality business. I see it as being a business that's unlikely to be disrupted. I think a PE of 18, if it's just going to steadily move along like it has in the past few years, I think it's a very reasonable price to pay for what looks like a quality business. What about you?
No, I tend to agree with that. And again, I don't think I'd probably be investing at the moment. I don't know enough about the publishing sector as a whole, and I suppose threatened by things going digital. I'd have to do more research into it, but the numbers on the surface of it looked good.
My very limited understanding of it going digital is if you buy Harry Potter and just buy it on Kindle from Amazon, the publisher's still getting paid.
But what's the margin like? What's that doing to the margins?
Well, they don't have to print a book out, so the margins could be better. I'd have to have a look, but I wouldn't necessarily assume the margins are worse. I think they could be better when you don't have to print and distribute physical books, especially books the size of Harry Potter.
And if they and I suppose if they maintained or increased the price, if they were able to maintain or increase the price. Yeah. I don't know how.
I think they are. It's not a huge disparity in prices between ebooks and physical books.
Yeah. So I don't know whether it's one of those things that Apple and Amazon, I mean, this just shows how little I know about the publishing industry, are going into it. So rather than going to Bloomsbury, what are Bloomsbury actually, what is their role going to be assumed by Amazon and Apple with sort of ebook stores?
And I guess if you're an author, you could possibly just self-publish on Amazon now.
Yeah, and Amazon get a cut, but you also get perhaps a better cut than you were getting from a traditional publisher like Bloomsbury. I don't know. I suppose they would be some worries that I'd have, and not knowing enough about the industry probably wouldn't be going that much further until I'd done my research properly on the whole sector.
It looks interesting. I'd certainly revisit it on the show. I won't be doing any further research, but I do think if you were to invest, I don't think it's clear cut. It may be that current trends help it. It may be that they hinder it, but I think that would need more investigation.
Yeah. So on to our American company for the week. American listed company Fiverr.
Yes. So Fiverr have come out their Q1 results. For anyone who doesn't know Fiverr, they're a website for outsourcing work, all kinds of work. It's basically the same business model as Upwork, which we've covered a couple of times on the show now, and I'm a shareholder of. Just to give an idea of the sort of things you can get on Fiverr, our intro and our logo both came from Fiverr. And I think it was probably about 30 quid for the intro and like £15 for the logo. So that, and if you'd got those things, like if you'd gone to a proper firm in the UK, you'd been paying hundreds for a product that's not necessarily going to be any better. And then there's all sorts of other stuff. You can basically outsource like full-time jobs and stuff like that. So Fiverr have come out with their Q1 results, and they've announced revenue in the first quarter of $68.3 million, which was an increase of 100% year over year. Active buyers for the first quarter of 3.8 million compared to 2.5 million in the prior year, with an increase of 56% year over year. Spend per buyer at 31 March of $216 compared to $177 a year ago, which was an increase of 22% year over year. Take rate for the quarter was 27.2%, up from 27.1% the quarter a year ago, an increase of 10 basis points year over year. The gross profit margin was 83.1%, which was up from 80% in the prior year. The net loss was 17.8 million or 49 cents per share. And that compared to $6.2 million or 19 cents per share a year ago. However, like a lot of the US companies we see, it is essentially an artificial thing because they're just plowing all the cash they can back into growing the business. So the reason it'll be so they've got losses is because they're plowing everything into sales, marketing, and R&D. It'd be quite useful to compare those results to Upwork's. So they're growing 100% year over year. That compares to revenue growth of 37% for Upwork. They've got gross margins of 83%, and that compares to gross margins of 73% for Upwork. It is worth noting that Upwork was performing poorly for a couple of years, and they've got a new CEO, Hayden Brown, and she's come in and she's really turned it around. Upwork have a market cap of $5.9 billion, and that compares to $7 billion for Fiverr. Upwork trades at price of sales of 15, and that compares to a price of sales of 31.6 for Fiverr. And Upwork's trailing 12-month sales were $404 million, and that compares to $223 million for Fiverr. So Fiverr's just over half the size, but it's growing quicker, and that's why it commands a multiple that's about double Upwork's. John, thoughts on these results, Fiverr's valuation, and comparison to Upwork?
Well, I suppose that is the big question, because the results are impressive, and they're similarly impressive from Upwork. I guess with both of the companies, they are very richly priced, but so far they have been delivering on the growth. In terms of a direct comparison between the two, I would probably be more leaning towards Upwork, but I think you could realistically have both doing well in that sector. It's not sort of a winner takes all game, I don't think. Or potentially, I'm a bit wary of the valuations of both of those companies, but if you were looking at the outsourcing industry, you might take a stake in both. I don't think you don't have to just back one horse in that race.
Yeah, I agree with that. I think if you look at the way the world is going, I just think outsourcing and companies like Fiverr and Upwork, I think in terms of the total addressable market, I think it's huge. And I don't see any reason why they can't both do extremely well. I think Upwork's quite interesting because Upwork, its price sales of 15, so it's half Fiverr. But Upwork was doing quite poorly for the first couple of years after it came public. So it was growing at 19% a year, and that growth was actually decelerating. Whereas Fiverr was putting up 60, 70% growth. And then the new CEO, Hayden Brown's come in, and she has, it seems like she's turned it around. So growth is now accelerating. It's up 37% a year. It wouldn't surprise me if Upwork growth continue to accelerate. Whereas with Fiverr, I think it's going to come down from that 100%. But
have you read 4 Hour Work Week?
I read it years ago.
Yeah, I mean, that's, if you believe in this industry, which, I think if you haven't read that book, it probably will convince you about this. And yeah, these are sort of two companies. I think they were probably, I suspect neither of them were probably public when the book was first written, but
No,
Tim Ferriss is an advocate of outsourcing, and these websites really, or these companies really facilitate that.
There's just so many things where, like, I mean, firstly, I should caveat it by saying, but you can get some very, very qualified people in Upwork. It's just where they are geographically that means they'll work a lot cheaper. But as an example, if like a lot of podcasts, they get the shows transcribed. That's not something we do. But if we were to do it, can you imagine paying someone in the UK minimum wage to transcribe a show? It's not worth it.
I'm sure £10 or so, yeah.
Think what someone would do in India for. You could probably get someone to do it for $2 or $3 an hour. And
that would still be a very competitive rate for
if you take $2
India,
or $3 in India, you can get a lot with it. So it's just like, if for a job like that, for us, if we were to start transcribing the shows, it would be a no-brainer to use something like Upwork.
I mean, it's amazing because with these websites, you can just put things out to tender for the whole world.
Yeah.
And whoever wants that job and is willing to do it at the most competitive price gets the job. And obviously you do have quality checks like ratings and rankings.
Yeah, and you can do there's interviews on there, and there's other stuff as well. Like I did a few Bitcoin articles a couple of years ago, and I had to put software on my computer, and it literally took a screenshot of my screen every 10 minutes. So the person paying me could see that the time I was charging him for was actually spent writing the article. There's all sorts they can do. And I actually think it's difficult. So I guess if you judge them on the valuation, they are very, very expensive. I think if you look at the size those businesses could be in 10 or 20 years, I think at that point, assuming those businesses will be amongst the winners, then they could still be very, very cheap. Because like, it wouldn't surprise me to see like an outsourcing business like Upwork or Fiverr, not necessarily Upwork or Fiverr, as $100 billion business. I think this, if you look at Uber as a $50 billion business or whatever it is, and then Upwork and Fiverr $7 and $5 billion, I think they could be a lot bigger than they are currently.
Yeah, no, I would agree with that. And it's not an industry. I mean, it's an industry that I back. Whether I buy shares in those two companies, I don't know. But yeah, I think as a sector, and it would be a very reasonable play to have a couple of those in your portfolio.
Yeah, I wouldn't be against actually owning Fiverr. I just can't bring myself to pay 31 times sales. But I do like the business a lot.
Yeah.
So, of the 6 companies we talked about this week, Pennon, Johnson Matthey, B&M, Intertek, Bloomsbury, and Fiverr. If you had to buy one, which one would it be?
I think it's fairly clear cut for me this week, and it would be B&M.
It'd be B&M for me as well, actually.
Okay. Are you going to buy any this week?
Probably not, no. I'm still building up an Airtel Africa position.
Okay, that was from a few weeks ago. Fantastic. Okay, well, when the show does inform us both as well.
Exactly.
Looking at companies you might not necessarily have considered previously, or
you're going to buy some B&M this week.
I don't know whether it'll be this week, but it's going firmly on the watch list. And in terms of retailers, I think I've got Tesco's, but I think it's fantastic. I think it really is good.
Yeah, it's probably the retailer. I think the last retailer we covered that impressed me like that was probably Kingfisher.
Oh yeah, Kingfisher, yeah.
Kingfisher's growth wasn't as good as B&M's. It was still good.
No, that's right. And the valuation as well. I think it's fairly priced actually.
Yeah, it was about the same. It was about P of 12 or 13.
Yeah. Great. Well, on that happy note, I think we'll thank you for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.